Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And the reason we are really locking our radar on Oklo today is because of the massive kind of whiplash-inducing volatility we're seeing on the chart.
Oh yeah, it has been a wild ride.
Right. Like if you've been tracking the broader markets, you know this stock has just been absolutely punished. I mean, it's down over 42% year to date.
Which is brutal for anyone holding it.
Exactly. And just a few days ago, on July 17th, it crashed all the way down to a 52-week low of $39.53.
Wow.
Yeah, the sentiment was just aggressively risk-off. It was a sustained downtrend punching the shares week after week. But then right as the panic seemed to peak, we saw this violent capitulation bottom form.
Right, because the stock suddenly popped today.
Yes, a 6.31% gap up, pushing it back to $44.13. So, the burning question for anyone watching this space is whether this is just a temporary dead cat bounce or maybe the start of a massive structural reversal.
Which is the million-dollar question.
It is. But before we break down exactly what is driving that price action, I want to share a really useful chart tool for investors and traders. If you want some help reading those volatile trading charts more clearly, you can check out VIP Algos through the link below in the description.
Yeah, that's a great platform.
It really is. VIP Algos is a TradingView indicator suite that shows visual buy and sell chart alerts. It has trend direction tools, support and resistance zones, and even take profit and stop-loss planning areas.
Which is super helpful for managing all this volatility.
Definitely. And it can be used across markets like stocks, forex, crypto, gold, indices, futures, you name it.
Right.
But we do need to emphasize, VIP Algos is an educational chart analysis tool only.
Right. Very important to note, it is not financial advice.
Exactly. It does not place trades for you,
and
it does not guarantee profits. Trading involves risk, so, always manage your risk and do your own research. Also, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Perfect. So, getting back to Oklo, let's look at why that massive price swing actually matters. Because frankly, looking at those violent 42% swings, I mean, it's very easy to just dismiss this as a highly speculative play.
Yeah, a lot of people do.
Like, it just feels like a casino chip for day traders.
Okay.
I'm really trying to figure out how a company that currently generates, well, absolutely zero commercial revenue fits into a serious long-term wealth-building portfolio.
I get that.
For a cautious, practical investor, tying up capital in a pre-revenue company sounds a lot more like wealth destruction than wealth building.
Yeah, and honestly, that skepticism is exactly the right lens to use here. You cannot evaluate a company like this using the same metrics you'd use for, say, a traditional software business or a blue-chip consumer brand.
Right, because there's nothing to measure yet.
Exactly. This is a deep tech, first-of-a-kind deployment company. In the infrastructure sector, we actually refer to this as a FOC.
FO.
Yeah, first of a kind. The wealth-building thesis here does not rely on next quarter's sales numbers because, like you pointed out, there aren't any.
Literally none.
None. It relies entirely on a structural shift toward this broader nuclear renaissance we're seeing and eventually a transition into a utility-like business model.
Okay, so you're asking investors to commit to a timeline of, what, years, not months. You're betting on future infrastructure that literally hasn't been built yet.
Precisely. This profile is for the investor looking 3, 5, maybe even 10 years down the line. I mean, it is the absolute definition of a high-risk, high-reward growth profile.
Got it.
The entire long-term value proposition hinges on them surviving this brutal gauntlet of regulatory approvals. But, once they clear those massive hurdles, the business model fundamentally shifts. Well, they transition from a cash-burning research lab into a project-financed utility. They secure these long-dated power purchase agreements, PPAs, with massive energy consumers.
Right, locking in the buyers.
Exactly.
Yeah.
If they can actually get these reactors built and turned on, we're talking about locking in decades of guaranteed recurring revenue.
Okay. Let's lift the hood on the fundamentals, though, because getting to that recurring revenue requires surviving a terrifying cash burn. I mean, the reality check here is stark.
It is.
As we mentioned, they are completely pre-revenue. Their trailing 12-month earnings per share is negative 83 cents. Free cash flow is totally negative.
Yeah.
Yet, despite just burning cash, the stock is trading at a price-to-book ratio of 2.88. And for anyone listening who doesn't obsess over balance sheets, Book value is essentially what the company's tangible assets would be worth if you liquidated it today.
Right.
So the market is pricing this company at nearly 3 times the value of its hard assets. What exactly justifies that massive premium when there is zero money coming in the door?
Well, what the market is pricing in is the intangible value of their moat. And for Oklo, that moat is built on 3 very distinct, highly defensible pillars.
Okay, let's hear them.
The first, and honestly, arguably the most crucial, is their regulatory first-mover advantage. They have an active licensing pathway with the Nuclear Regulatory Commission, the NRC.
Oh, wow. And getting anything through the NRC is notoriously difficult. I mean, it's essentially the highest regulatory hurdle in the U.S. government.
It is a monumental task. The NRC approval process for a new commercial reactor design typically takes 5 to 7 years.
5 to 7 years.
Yeah, and it costs hundreds of millions of dollars. So the barrier to entry isn't just high. For most startups, it's a brick wall. But Oklo has a massive head start in this grueling process.
Right.
That intellectual property and that regulatory progress is an almost insurmountable moat against competitors who are, just sketching out their initial designs today.
Okay, fair enough. But a regulatory head start only matters if you actually have fuel to put in the reactor, which brings us to a huge bottleneck in the nuclear space. True.
You can have the best reactor design in the world, but if you can't source the actual uranium, it's just a really expensive paperweight.
Which brings us directly to their second pillar, which is vertical integration, specifically around fuel recycling. Their compact, fast reactor design uses a metallic fuel that can actually be recycled.
Oh, interesting.
Yeah. And recently, the Department of Energy approved the Nuclear Fuel Cycle Consortium Voluntary Agreement. This includes major players like Solstice's Advanced Materials, Mirion Technologies, and Amentum. This agreement directly supports their strategy to access HAEU.
Let's pause on that acronym for a second. HAEU. That stands for High-Assay Low-Enriched Uranium, right?
Exactly.
So why does this specific company need that as opposed to just the standard uranium used in old-school reactors?
Good question. Standard nuclear fuel is enriched to around 3 to 5%, but HALEU is enriched to between 5 and 20%.
So it's much more concentrated. Right. Because it's denser and much more potent, it allows these new advanced reactors to be remarkably small, yet they can run for decades without needing to be refueled.
Wow, decades.
Yeah. Standard fuel requires massive cooling towers and sprawling facilities. HALEU is the actual physical mechanism that makes this entire microreactor design possible in the first place.
So they really can't function without it.
Exactly. Securing a domestic supply chain for this highly specific fuel is critical, and this DOE agreement proves they're actively building that exact supply chain.
Okay, so they have a regulatory head start, and they have a strategy for this highly concentrated HALEU fuel. But how do they actually monetize this? Are they just going to sell these blueprints to traditional utility companies to build?
No, and that is the third pillar, the owner-operator model. This is where the long-term wealth thesis gets really highly differentiated.
How so?
While most of their competitors just want to license a reactor design and walk away. But this company doesn't want to just sell the blueprint. They intend to own the plants and sell the electricity directly to the end user.
Directly to the end user? Like who?
They're targeting dedicated off-grid power for massive data centers, military bases, heavy industrial facilities, things like that.
Let me see if I have the mechanics of this right. It's almost like building a bespoke high-security power bank for a single massive client-like an AI data center.
That's a great way to look at it.
So you front the terrifying capital cost to build the power bank. It drains your resources up front. But once it's built and actually plugged into their specific campus, the switching costs become physically impossible.
Exactly.
The client can't just, unplug and buy a grid connection from someone else because the traditional grid physically cannot handle their massive energy load. So you have a captive audience and you just sit back and collect the utility payments for 20 years.
That captures the mechanism perfectly. You endure the massive capital burn up front to secure an absolute monopoly over a captive audience later.
But enduring that capital burn requires actual cash in the bank. I mean, how much runway do they really have to survive this heavy R&D phase without diluting shareholders into oblivion?
Well, that's actually the silver lining on their current balance sheet. They went public via a SPAC merger in 2024, and they raised capital through subsequent follow-on offerings.
Right.
So right now, relative to their pre-revenue status, they are incredibly cash-rich, and they carry minimal long-term debt. That fortified balance sheet gives them the critical runway needed to navigate this complex licensing phase without immediately going bankrupt.
Okay, so they have the cash runway to survive, but simply surviving isn't going to drive the stock price up from a 52-week low. What is the actual spark that's going to validate this business model for investors in the near term?
We actually have a few crucial catalysts stacking up in the next 3 to 6 months.
What are we looking at?
Well, in August 2026, we have their Q2 earnings report. That's crucial for updates on cash burn and any new power purchase agreements. Moving into the second half of 2026, we're looking at major milestones for their NRC Combined License Application, or CCOLA.
Okay, that makes sense.
And then kind of hovering over all of this is the broader macro event. Potential Federal Reserve rate cuts expected in September 2026.
Wait, let me challenge that macro point. Why does a pre-revenue nuclear startup care if the Federal Reserve cuts interest rates by 1/4 of a point? You just said they are carrying minimal debt and are mostly equity financed right now.
Right, it seems counterintuitive. But it comes down to how infrastructure projects are valued by the market. Nuclear facilities are incredibly capital intensive and take years to build.
Right.
So when analysts try to figure out what this company is worth today, they use a discounted cash flow model. Lower interest rates drastically reduce what we call the weighted average cost of capital, or WACC.
Oh, I see. So basically a dollar earned 10 years from now is worth less today, but exactly how much less depends on interest rates. Because they're spending billions of dollars today for a massive payoff that won't happen for 10 years, any drop in the cost of borrowing right now acts like a massive multiplier on their future valuation. The Fed cutting rates is essentially cheapening the cost of their entire runway.
That is exactly right. When the cost of capital goes down, the present value of those future decades-long cash flows goes up significantly. It directly improves the underlying economics of every single project in their pipeline.
Interesting.
So a dovish Fed is a major macro tailwind for capital-heavy infrastructure plays, even if they aren't holding massive debt today.
Okay, so the macro environment might provide a tailwind, and regulatory milestones could provide a spark. Let's look at how the market is actually pricing that potential right now by checking the chart.
Let's do it.
Because the price structure here tells a very grim story of multi-week returns. If you look at the 13-week return, it's down 35%. Over 26 weeks, it's down over 59%. Yeah, and keeping things in perspective, this stock had a 52-week high of $193.84 back in October 2025. Today, it is trading at $44.13. It has just been a brutal, sustained descent.
It really has been incredibly painful for early shareholders. But, this is where the technical setup becomes fascinating. We have to look closely at the anatomy of today's reversal.
What are you seeing?
That positive 6.31% gap up happened right off the recent 39.53 low. And more importantly, it happened on contracting volume. The 10-day average volume is sitting at about 0.68 times the 3-month average.
Wait, for someone who doesn't stare at order books all day, why does contracting volume matter when a stock is gapping up? Doesn't a healthy bounce usually require heavy buying volume to be legitimate?
Typically, yes, you want heavy volume on a breakout. But when you are looking at the very end of a massive, sustained downtrend, contracting volume often signals a capitulation bottom.
A washout.
Exactly. When the selling volume starts to completely dry up, right as the price bounces off a psychological floor, in this case around the $40 support level, it suggests that selling exhaustion has finally set in.
So the panic is over.
Right. The weak hands have been washed out. The people who were going to panic sell have already exited the market. The ask side of the order book clears out, so even a tiny bit of buying pressure creates a massive 6% gap up.
That makes sense. But we also have to highlight the inherent volatility of this setup. The beta on this stock is 1.23.
Right. A beta of 1.23 means this stock is historically 23% more volatile than the broader market. It swings much harder in both directions.
When the market sneezes, this stock catches a cold.
Exactly. But conversely, if a positive catalyst hits, say, a surprise milestone with the NRC, that same volatility can produce outsized, violent upside moves.
We can definitely see that potential energy in the chart. But, a chart is ultimately just a historical record of what already happened. If we want to know what the big money thinks is going to happen next, we really need to look at market sentiment.
Absolutely.
And we have some very heavy hitters making bold moves here. Cathie Wood's ARK Invest just stepped in and bought over 100,000 shares. Roughly $4.7 million worth of stock right as the shares were plummeting.
That is a massive display of institutional conviction. catching a falling knife during a 42% year-to-date drawdown requires serious belief in the long-term thesis. ARK clearly views these depressed price levels as a deep accumulation zone.
Clearly.
And it's not just ARK. We also saw Truist Securities initiate coverage on the stock just days ago with a hold rating and a $55 price target.
I have to say, a hold rating isn't exactly screaming from the rooftops to buy. It feels a bit, well, tepid.
It sounds tepid on the surface, sure, but context is everything here. Initiating coverage with a $55 price target when the stock is trading in the low 40s implies nearly 25% upside.
Okay, that's a fair point.
Right. For a newly initiating sell-side analyst to step in during a massive violent downtrend and publicly say, we see 25% upside and limited downside from here, that acts as a very strong stabilizing force for market sentiment.
I hear that, but we have to address the glaring red flag in the sentiment data.
Which is?
Over the last 90 days, there has been a net insider selling of 1.29 million shares.
Yeah, that's a lot.
It is. The insider ratio is sitting at a negative 90.40. That is a massive amount of stock being dumped by the exact people who know the internal health of the company better than anyone. How do you reconcile heavy institutional buying with massive insider selling?
It is definitely a yellow flag, and you generally never want to see insiders indiscriminately dumping shares. But what to look at the structural history of the equity.
What do you mean?
Well, the company went public via a SPAC in 2024. What we are highly likely seeing here are post-SPAC lockup expirations.
Ah, okay.
When those mandated lockup periods end, it is standard mechanical behavior for early insiders, founders, and early venture backers to sell portions of their holdings to gain liquidity. They need to diversify their personal wealth.
Because they've been locked in for years.
Exactly. Selling to buy a house or diversify doesn't necessarily mean they're panic selling because the reactor technology is failing. You certainly want to monitor it to see if the selling eventually tapers off, but it's a very common feature of companies that took this back route.
That provides some reassurance for sure, but we still need to confront the fundamental risks. Because designing a nuclear company is not like coding a new app. The reality check here is brutal.
It's the toughest industry in the world.
Right. The NRC has never, let me repeat that, never licensed a liquid metal-cooled fast reactor for commercial power generation in the United States.
That is the massive elephant in the room.
It's the entire room. Any delay in that unprecedented licensing timeline extends their cash burn without a single dollar of revenue coming in. If the NRC drags their feet for an extra 2 years, the cash runway evaporates.
It's a huge risk.
Furthermore, let's look at the broader competitive market. We just saw the state of New Jersey announce a $24 billion nuclear expansion. And you know what they did?
They went with traditional tech.
Exactly. They completely bypassed small modular advanced startups like this one. They went straight to the shovel-ready Westinghouse AP1000 technology. If states with massive budgets are actively choosing legacy, proven tech over advanced fission, doesn't that completely cannibalize the addressable market for these microreactors?
That is a very valid structural concern, and it highlights the extreme execution risk here. The regulatory delay is absolutely the single largest existential threat to the company.
Okay.
However, regarding the New Jersey expansion, we have to clearly differentiate the target markets.
Yeah.
This company is not trying to power the entire regional grid of New Jersey.
Oh, right.
That is exactly what giant multi-gigawatt Westinghouse reactors are built to do.
Yeah.
Oklo is targeting a completely different parallel segment, distributed dedicated power.
Like the data centers.
Exactly. You physically cannot put a massive AP1000 reactor next to a data center campus in Northern Virginia or on a remote, highly secure military base. The footprint is too massive, and the water cooling requirements are just too immense.
Right, they wouldn't fit.
These smaller, fast reactors are designed specifically for off-grid, localized clients where giant traditional reactors simply cannot go. So New Jersey, going with Westinghouse, doesn't actually eat into the core pipeline of data center PPAs.
That makes a lot of sense. So with all the pieces on the table, where does that leave us? We have a pre-revenue company burning cash, facing unprecedented and unproven regulatory hurdles, and insiders actively trimming their positions. But on the flip side, we have institutional accumulation for major players, a fortified balance sheet, a dominant first-mover regulatory moat, and a business model that seems perfectly engineered for the AI data center boom.
Right. So based on the underlying data, the technical floor, and the catalyst timeline, the final verdict lands at a bullish score of 6 out of 10.
A 6 out of 10. So cautious, but leaning optimistic.
Correct. The stance here is that this is a contrarian medium-term hold looking at a 3 to 9 month horizon.
Okay.
The risk-to-reward ratio here is highly asymmetric.
Hmm.
It favors a long position heading into the August earnings and the upcoming NRC catalysts in the second half of the year.
Yeah.
But, and this is a big but, that entire thesis only holds as long as the stock remains above that 39.53 floor.
So that support level is critical.
Absolutely critical. If it breaks below that 52-week low, the near-term technical setup is entirely invalidated. The main upside driver is purely regulatory and commercial. Any announcement of an NRC milestone or a new power purchase agreement for a data center could trigger a massive re-rating of the stock.
Good to know. But to be absolutely clear to everyone listening, this is an early-stage company carrying extreme execution risk. This discussion is purely for educational purposes and is not financial advice.
Right.
Do not buy or sell a stock based solely on this analysis. And if you want a cleaner, more systematic way to read the trading charts for volatile stocks like this, check out VIP Algos through the link below in the description.
It's a great tool.
It is. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts much easier to scan, but remember, it is still only an educational chart analysis tool.
Exactly.
It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk appropriately. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if today's analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next talk.
Before we wrap up completely, I want to leave you with one final thought to mull over. We spent a lot of time today talking about how this company is positioning itself to power the massive data centers required for the AI boom.
We did.
But if multi-billion-dollar tech giants are becoming so desperate for reliable electricity that they are actively turning to unproven, first-of-a-kind nuclear startups to go completely off-grid, well, what does that tell us about the hidden fragility of our broader traditional energy infrastructure? Keep an eye on the power grid because the smart money seems to be looking for an exit.